Welcome into this week's On the Spot. I'm Tony Mulvey, joined on the phone by Kevin Hill. Kevin, how are you?
I'm doing good today, Tony. How about yourself?
Can't complain. It's not raining today here in Freight Alley, so really can't complain. But going to talk today a little different than maybe what we've talked about. We've talked about it a lot, and that's contract rates and when they'll start to roll over. And I think we're starting to kind of see that happen. I mean, we'll pull up a chart here in just a minute, and it'll be our van initial contract rate per mile, and you can see from the peak in June all the way through. So this is on a 14-week or 14-day lag, not 14 weeks, 14-day. It's down to 286, which is roughly where it was back in, say, February, and it's down about 4% from its high there in June. And it's a steady decline, a slow decline, but it's a decline nonetheless. And then in the green line was our NTIL, so that our National Truckload Index line haul only. So you can kind of see the comparison between both contract and spot rates, excluding those fuel surcharges. Kevin, I'll ask you, is this the start of the rollover in contract rates?
I think it is. It's the great rollover. We can coin it. Maybe there's a better term out there. Who knows? But the great rollover. We're going to see a rollover. I think the more we look upstream in the supply chain, in raw materials, in commodities, the more we're seeing a rollover. We're seeing a rollover. The inflation has been knocked down. I think a lot of it was supply chain issues. A lot of what people called inflation were supply chain bottlenecks that had built up in 2020 and 2021. And you can have an argument whether that's inflation or not, or what definition to use. But we saw an increased costs in the supply chain that bid up raw material from production to supply chain to the end consumer. I think when we look upstream where all these cost rises, cost increases started, we're seeing a rollover in just about every class of commodity and service and logistics being one of those.
Yeah, I mean, if you looked at the PPI this morning, it fell against expectations of rising in July. So, I mean, you're seeing kind of that. And then you see the CPI, right, the day before was flat month over month, which is a good thing when you don't see those declines. Granted, it's still at 8.5% year over year. So, I mean, there's still those inflationary pressures, but they're not increasing inflationary pressures.
Yeah, it's all downstream, right? The consumer is seeing this. And we saw it months before the consumer really saw it, before the 8%, 9%, 10% inflation prints coming out. I mean, we were calling for inflation back in January. Yeah. I know Anthony Smith and I did a segment on FreightWaves Now about that, and about the second half of 2022. So what we're saying, though, really is that upstream, the inflation pressures that you'll see downstream in the next few months have dissipated in a large respect. I mean, it's certainly not going strong anymore.
Yeah, for sure. And a lot of those declines will be that slow, steady decline. It's not going to be an instant, basically.
Yeah, it's not going to be 0% inflation next month or in 2 months. But when people are talking about peak inflation has been here, and I think it's passing right now.
Yeah, and we'll bring up another chart that kind of shows what carriers are doing, right, and how they're reacting to the market. It's a rejection rate, and we're sub 6%, right, at 5.99%. And I've got it pulled up here compared to the last 3 years. So 2021, there in the blue line, you can see we saw that decline in July, but at 20+%. Then you've got the green line, 2020, we were headed up, and that's when that boom cycle. But then you look at 2019, and guess what? Right now is very similar to 2019. We're a little higher than where we were in 2019. But I think when you factor in some of those inflationary pressures that we've seen contract rates where they're at. I mean, now you're seeing the down movement, right? And it's just been a continuous down cycle, and you haven't seen any positives to drive rejections back up, I guess is what I've seen.
No. I mean, you had you don't have this bottleneck anymore. This freight is moving a little bit smoother, but then you have the contract rates. As long as they're up at the elevated pricing compared to the spot market right now that they are, compliance is going to be great. You're going to see 5-6%. You're going to see a very slow market and very, very loose spot market. But when contracts prices are coming down, you're going to get more and more competitive with spot, which should increase some volatility in the market.
Yeah, I think that's
It's going to be a slow process, though.
I was to say, yeah, we're not seeing that volatility. And I mean, I think when you factor in diesel prices, we'll bring up one last chart and you can see the spread. Me and Donnie talked about it this morning. We've talked about it every day. The difference in diesel truck stop prices at the retail and then the wholesale price. I mean, you're looking at $1.60 per gallon difference. And if you're making $1.60 basically per gallon and then factor that into your miles per gallon, I mean, you're making, and you see it in these earnings releases, that big carriers are making money on fuel surcharges. There's no reason for them to abandon that contract. That's why you're seeing lower rejection rates.
Yeah, I mean, it's perfect economics. I mean, there is really no reason to abandon that. The compliance is going to be high, and that's what we're seeing in the data.
Yeah, absolutely. Well, thank you, Kevin, for joining me this week's On the Spot. That's all the time we have for this week. But right now, we'll take a quick break, but we'll be back with more Freight Waves Now.